Are you interested in buying a technology stock with a potential annual rate of return of over 40%? Well, this video is for you. Hey everyone, welcome back to another video here at FiscalVoyage. My name is Felix. So in this video, we're going to do a stock analysis on Micron Technology. This video was suggested by Tonocho, which I hope I'm saying that correctly. Thank you for watching a previous video and commenting and suggesting for me to do a stock analysis on this video. So make sure you watch towards the end of the video because I'm going to provide you with a fair value price and my current recommendation of either buy, hold, or sell. But before we get started, if you're new to the channel, make sure to hit that subscribe button. And if you enjoyed the video, hit that like button for the YouTube algorithm, as well as check out my free ebook in the description below. 5 quick metrics to look for before spending more time in looking into any company. Free ebook in the description below. All right, Micron Technology stock, ticker symbol MU, is an American producer of computer memory, computer data storage, including dynamic random access memory, flash memory, and USB flash drives. It is headquartered in Boise, Idaho. Its consumer products are marked under the brands Crucial and Ballistic. Actually, I'm a big fan of Crucial memory sticks. A lot of my computers were used Crucial memories, so a very good product here. Fundamentals for the company: revenue grew at a compound rate of 12% from 2010 to 2019, and fiscal year 2020 already ended in August, so their next quarter should report 2020 fiscal year revenue, so that should be interesting. Net income grew at a rate of 14.6% from 2010 to 2019, so very good revenue growth and net income growth. Company has a triple B minus credit rating. It's not the best credit rating, but it is an investment grade rating from S&P Credit. 10-year period operating income also grew at 18.7%. So overall, the top line of the company has been growing very nicely. Earnings per share growth at 14.7% in that 10-year period. And the past 5 years, the company grew at 23.6%. Earnings for the past 5 years, and net income over the past 5 years grew at 21.5%. So net income and earnings has been increasing very dramatically over the past 5 years, and this is because net margin has also increased, and we'll talk about that in the next slide. Revenue for the past 5 years grew at 9.7%, so it is lower than the 10-year average, but still at a respectable rate. Fundamentals continues. For 2019, the company earned $6.35. Net margin came in at 27, which is lower than 2018 fiscal year of 46%. However, it is much higher than 2014 and 2015, where they earned 18% and 17%. Return on equity came in at 24% for 5-year average, so that's very nice return on equity. Price to sales is higher than the 5-year average at 2.7 versus the 1.9 5-year average. So it might be an indicator that it is overvalued based on the 5-year price to sell average, but it's still a very nice price to sell ratio at 2.7. PEG ratio is high here at 6.96 versus the 5-year average, which I didn't was able to calculate because there were some from Morningstar. It has some negatives, but currently right now it's 6.96, which is high. I like to see a PEG ratio under 2, so there's something to consider there. Enterprise value over earnings before interest, taxes, amortization, and depreciation is at 6.5 versus a 5-year average of 4.7. So it might be overvalued here as well based on this ratio. The balance sheet, however, is outstanding. Debt to cap ratio only 15%. The current ratio, which is the current asset divided by current liabilities, is 2.9, which is real good. Like to see this at 1.5 and higher. Debt to equity ratio at only 0.19, so outstanding debt to equity ratio. Interest coverage at 14.7, outstanding as well. You'd like to see this at 2.5 and higher, so real good interest coverage. Price to book ratio at 1.4 versus the 5-year average of 1.7. So this is a good indicator that based on the balance sheet, the price to book ratio is very good versus the 5-year average. So that's something positive there. Future outlook: analysts are expecting 2020 earnings to be $2.76. This is much lower than the 2019 earnings of $6.35. However, for 2021, analysts are expecting a $3.85 increase versus the 2020 expected earnings. So that's a very nice increase. It's about 30-40% increase in earnings. So that's very positive there. CFRA has a projected earnings growth of 8% for the next 3 years. And using the dividend dual return model, even though the company doesn't pay out a dividend, I still input it as 0 for dividend. Came in at 17.1% total return for the foreseeable future. So that's very positive. Forward PE at 12.8 versus a 5-year PE average of 14.6. So that's very nice PE ratio versus the 5-year average. And considering you look at the next line, the fast graph, earnings are expected to be 30%, 40% in the next few years. So that's very growth for the next few years. That's very positive at only a very low multiple. The current PE versus based on the 2019 earnings came in at 17.4. So forward PE is much better than the current PE. So that's a positive there. So let's look at the fast graph for this company. Micron Technology Inc. Again, ticker symbol MU. So you can see here, there's been very erratic earnings, negative earnings. You hear 2002 at negative 80 cents, 2003 negative $1.90, and then it picked up nicely here. But then in 2008, 2009, negative earnings as well. 2012, negative $1.04. But since then, the company has been growing earnings very nicely. You can see here, 8,000% in 2017. 2018, 141%, 2019, a negative 47%, but still very nice positive earnings of $6.35. This year is going to be down 57%, but this is where the kicker is. Analysts are expecting 40%, 62% for 2021 and 2022. So it can present a nice capital appreciation because the current PE is about 17.6, and when you have a PE of about 17, and this is based on fiscal year 2020. And as you saw, the PE, forward PE based on 2021, $3.85 is much lower at about 12. If you have a PE of between 12 and 17 with a earnings growth of 40% to 62%, you have a great chance for capital appreciation, so making the stock price of the company much higher than what it is. So we're showing this time period and look at more recent years. You can see here, let's close that 1 year here. You can see here with a P of 17, and if the company does grow earnings at 40% to 62%, you have a nice rate of return. And this is based on a PE of about 50, which is very unlikely. So let's change this to a reasonable PE of around 15. If we apply that settings, and then let's shorten this time period again, and let's erase that drop. You can see here, even at a P of 15, you're going to have a total annual rate of return about 40%, which is outstanding. Making 40% every year is something we all wish for, right? So this is definitely a great opportunity here that I see based on the fast graph and the other fundamentals that we looked at. So Micron Technology does look like a very nice buy. So let's look at the forecast. Analysts are estimating about 10% growth. And there's a lot of analysts. You can see here 30 analysts, 31 analysts, 13 analysts for 2022. So the growth is there. You can see here, again, 40% total annual rate of return projection. The only thing I don't like about this company is that they don't pay dividend. You can see here, no dividend payment. But again, S&P credit rating, BBB minus, investment grade, very low debt to cap ratio. So overall, very positive here based on the fast graph. All right, for Micron Technology stock, let's look at the fair value price slide here. CFRA has a fair price for Micron Technology at $55, Morningstar at $48, Fast Graph, as you saw, $57.75. Yahoo came in at $63.65. I couldn't analyze a dividend discount model because they don't pay a dividend, but averaging out to 4, we get a fair price of $56.10 for Micron Technology. That based on the current price of $49.20, that means the company is undervalued by 14%. So this meets my criteria of 10% or 15% higher of undervaluation, and this is why I have a buy recommendation for Micron Technology. So there you have it. I think Micron Technology is a buy at current prices. Revenue growth, operating income growth, net income growth has been outstanding over the past 5 years, 10 years. Earnings growth has been outstanding as well for the past 5 years, 10 years. The only thing I really don't like about this company is the fact that they don't pay a dividend. I am a dividend growth investor. I do have some shares of different companies that don't pay dividend, like Google and Facebook. But overall, Micron Technology does look like a buy at current prices. When I say buy, it means to research more into this particular company and invest your time into this company to research, because I think at current prices it presents a great opportunity for you as an investor. Micron Technology stock balance sheet is outstanding at only 0.19 debt to equity ratio, as well as an interest coverage of 14.7. So that's very good balance sheet for this company. So overall, Micron Technology is a buy. I like the company. I like their products. So make sure you guys research this company and let me know what you think in the description below. Do you already own shares of this company, or are you planning to buy shares of this company? So if you're new to the channel, make sure to hit that subscribe button, like this video, and check out my free ebook in the description below. And I'll see you guys in the next one.